welcome to Markets Next Week. We've shut out the September series. October has a lot to look forward to. We've got a rate policy in the annual. We've got a lot of earnings to grapple with over the next 1 month and auto sales. It's going to be an action-packed month for sure. We've got a whole research team standing by to take us through the cues you need to watch out for markets next week. Shell with all the fundamental clues, Pranoy with the derivative action, and Hiral with chart attack as usual. We also get you the biggest voices in the markets from Wall Street. Arvind Sanger tells us why RBI cannot solve all the problems. Shaurya Doval on whether India is still the bright spot. An exclusive conversation from the New York conference of Ambit as well. But first up, as usual, we will also be speaking to our fundamental guest, Mayuresh Joshi from Angel will be joining us. Shell standing by to tell us how the week gone by has been and what we need to watch out for.
Aside, what a week it has been. For the whole week, we've gone in and lost almost 1.4%. But in all 4 trading sessions, we've seen quite volatile movements. So if you see see Monday and Tuesday, these are the 2 days when the markets went and ended lower. We lost approximately 170 points on the Nifty in these 2 days. And then Wednesday and Thursday, when a slight bit of a recovery came in, and we went in and gained almost 60 to 70 points. For the whole week, in point form on the Nifty, we have gone in and lost well over 110 points. Also, a few stocks which deserve a mention. Tata Motors was one of those stocks which went in and saw a downward move of 8% in the last 4 trading sessions. On the other hand, when you're looking at a few stocks which did well for themselves, Lupin and Kane, both these stocks went in and ended up by 4.5%. For the next week, 2 or 3 major things to watch out for. The first thing being that Prime Minister Modi will be in the US, so any kind of commentary coming in from there will be quite important. Also on Tuesday, we have the RBI credit policy, so any kind of commentary or any kind of actions which come in from the RBI will definitely be market moving. Also next week will be a truncated week because Friday is a trading holiday, and also on Monday morning itself our markets will react to the commentary coming in over the weekend from Janet Yellen. So it promises to be quite an exciting week as well.
Thanks for that, Shell. Mayuresh, thanks for joining in. Long weekend for sure, and it's going to be a good one, much needed one after the turmoil we've seen in September. How's the market position now, according to you? How is risk sentiment looking like, and how do you think just the appetite for risk is in the market now?
So clearly, I think there are 2 aspects to look at the market positioning, specifically from an India perspective. Global cues obviously are taking center stage at this point of time. The Chinese PMI data has not helped soothe global equity markets at all. The emerging currencies are facing problems. So I think those problems are there to persist for some length of time. And even domestically, I think if you look at the few trigger points that are coming up, next week's RBI policy, a lot of expectations in terms of a 25 bips rate cut has already got built into the market, in my opinion. What happens with Bihar and the outcome thereof, I think that will be a key pertinent point for the markets in terms of market direction going forward. But structurally, I think corporate earnings is something that need to improve. And clearly, we're not expecting corporate earnings to improve drastically, at least as far as Q2, Q3 numbers are concerned. So I think the fall in raw material prices will actually start exhibiting positively in the second half. Add to that, the government spending and the way the intention of the government is to get reforms. I think if these 2 factors start moving in tandem, you'll see the capex cycle and investment cycle turn for the better probably in the second half or the first half of FY17. So at least from a short-term perspective, our take is the markets are there stuck in a range. I think it's a broad range that we're talking about, but I think 7,500, 7,600 on the lower side, 8,100, 8,200 Nifty should be the range that the market should persist with.
Well, let's hear in what Ambit makes of this market. We caught up exclusively with Ashok Vadhva as well as Saurabh Mukherjee as part of the New York conference. Here's what they make of the markets and the road ahead.
The mood is a little muted. Muted certainly in comparison to what we saw a year ago at the conference last year. Largely because Mr. Modi won this election on the expectation that significant reforms would be made. Now, nobody says that Mr. Modi has a magic wand and that a lot more should have happened. But clearly the fact that our parliament has not been able to act in a manner which supports at least a discussion on these reforms indicates that, frustration is creeping in. And people are feeling more and more concerned that if with such a large mandate, Mr. Modi is not able to get reforms acted and enacted, then is there a larger challenge here? So I would say in summary, muted compared to last year, but certainly I wouldn't say disillusioned. people continue to believe that India has the capability to separate itself from the emerging markets. And even if the other emerging markets continue to underperform, India in due course shall perform.
What is your view as far as the markets are concerned in the same time frame that you just spoke about?
So the way we see it, Siddharth, is as follows. If you ask me fair value for the Sensex today, I think fair value for the Sensex for FY16 and I reckon is around 28,000. We're around 26,000 in the Sensex as we speak, and 28,000 I would say is fair value for the Sensex. But
you haven't revised it down.
But because of a range of factors around the money market, which I was just mentioning, the banking system and the money market, around the uncertainty arising from China and the impact of that on the Indian capex cycle, around the fact that consumer demand is pulling back and the real estate ecosystem is crumbling, we reckon there's a really high chance we could touch 22,000 over the next 6-7 months, 22,000 in the Sensex, on the back of the various dislocations that are taking place within our country and outside.
We also have an RBI policy on the anvil next week. On Tuesday, we will see our RBI Governor Raghuram Rajan take center stage once again. I can tell you that the poll of economists, 30 economists, is showcasing an overwhelming majority. I'm tempted to say almost unanimous call for a rate cut. Only one calling out for a 50 basis point cut, a majority calling out for a 25 basis point cut, as the CPI continues to undershoot the RBI's target of 6%. We do expect the RBI to step back and cut their inflation as well as their growth target in the upcoming policy. But the big question is, will they take a hawkish tone, and will we see a prolonged pause after the September cut? That's the big one to watch out for, and you can catch all the coverage right here on Bloomberg TV India. Mayuresh, has 25 bips been priced into the market, and how will this market take a hawkish tone from Governor Rajan? Will that truly give heartburn?
So you said it, I think the markets will not like a hawkish tone at all. So I think the markets obviously look for positive developments, positive figures all the time. So clearly I think if it's a 25 bips plus hawkish stance that the governor meets out, I think as I mentioned earlier, 25 bips is more or less digested by the market, that it is a given that it should probably come in the policy. But again, if the tone is hawkish because you're not really sure on how data will pan out, what happens with China, what action the Fed will does, because even that is a big overhang that the markets are looking for at least over the next few months, that will not go down well with the market. So again, I think our entire take is that the markets to stay in the range, and I think largely factoring in a 25 bips rate cut by the RBI.
Well, one thing is for sure, even as the reform pace slows down, global market experts believe RBI cannot solve all the problems. That's the word coming in from Arvind Sanger. Siddharth Zorabi caught up with Arvind Sanger as well as Shaurya Doval in New York to find out what the investor view is on India now.
In terms of emerging markets, India is looking attractive. This is a window that has opened for India, and India must make the most of it, in my view, because we live in a world of relative opportunities and costs. So absolutely, India is very, very attractive at this point in time.
India is very, very attractive. Is that an assessment that you share, Ravi?
Yeah, I mean, I think there is a window of opportunity here because of China's slowdown, commodity price correction, oil price correction, and growth which seems to be more internally driven for India than almost any other emerging market in the world. So all of those factors are coming together, along with one of India's major headwinds going away, which is inflation, and India probably uniquely positioned on an interest rate cutting cycle ahead of it, and all of those provide room for optimism. Although frankly, let's be clear, India's own recent performance, notwithstanding the official GDP numbers, has been disappointing in terms of corporate earnings performance, and probably the old GDP numbers would reflect a lower number. But having said all that, I think the opportunity is there for India to shine.
Okay. I'll just add one more thing to that, what you just said, that while the window is open, it is, at least that is what I heard when I spoke to investors the last few days, is that it is not a natural corollary that India will benefit because of this. India still needs to do a few things to be able to make use of this opportunity that has opened on the macro side.
What are those few things that India needs to do at this point in time?
Well, I think clearly, not needs to do, but I think will happen as a natural consequence is obviously the monetary cycle helping, but it's not enough. And I think
tell me about the monetary cycle a bit more, because that's one of the hot button issues that everyone is talking about back home.
Well, I think Indian corporates are over-focused on the monetary cycle. I disagree with the idea that if Rajan cut interest rates, everything would magically be right in the Indian economy. I think that's an unfair, pressure to put on the RBI and on Raghuram Rajan. I think,
and Mr. Rajan recently spoke about interest rate lobbies, not to exactly sort of put these words in his mouth. That's what he was referring to.
That's right. So, but I think that, a lot of things need to happen. I think corporate capex needs to pick up. I think government infrastructure capex, whether it is on road, it is on rail, it is on other infrastructure projects, where we're seeing some signs, but more needs to happen, and that will drive the positive momentum, because right now you can point out a lot of negatives, right? The real estate is in the tank, and corporate capex is extremely slow to recover because there's still surplus capacity. So we need to see some elements of the virtuous cycle. Clearly, some amount of urban consumer spending is picking up. So there are some signs of recovery. We need to see more of that virtuous cycle take hold.
Mayuresh will also be grappling with earnings not just next week, but actually all throughout the next 30 days. What is your sense of earnings now? Have we seen the worst? Do expectations still need to come down? Will we go in with a muted set of expectation and still see a disappointment? What's really the market thinking?
So I think you have to look at different sectors in this scenario. I think if you're looking at the commodities play, it might be a little bit of a disheartening fact that some more downgrades might actually start coming through. So if you look at the core data that is coming through, the realizations have fallen very, very sharply. And though there has been an equal amount of fall in terms of input prices, both in terms of pet coke, coking coal, iron ore prices actually being down, again, I think the benefits in terms of how the offset will happen in terms of margin expansion will not probably be seen through. So I think a lot needs to be seen on how the Chinese demand-supply situation pans out over the next few months and quarters, what happens on the LME side in terms of core realizations going forward, which you believe will be very, very muted. Again, on the energy pack, specifically on the oil and gas stocks, I think a lot has been said about our stay, and if the oil prices stay in this range, you're probably going to see the oil stocks also take some amount of beating in that sense. So clearly, I think the OMCs have just stated to the fact that the inventory gains, the under-recoveries are largely built into the price. The structural re-rating for OMCs will probably start happening when marketing margins start expanding meaningfully. FMCG, again, as a sector, our own take is that volumes will see a little bit of degrowth in terms of what the market's expectations are. There's been poor rainfall, so again, I think the whole trend in terms of rural discretionary demand and spending will actually go down over the next few quarters. And though you might witness gross margin expansion because fall in input costs have been quite significant over the past few months, I think the volume growth will still be a concern. So I think in terms of cyclicality, how asset quality pans out will be a key pertinent for a lot of the PSU banks, how credit growth is panning out. So in a nutshell, probably, I think we're not expecting great earnings to come through probably as a whole in Q2.
Well, we'll take a short break. On the other side, we get you the promised chart attack and a quick look on autos as well. Festive season, is it really going to be cheerful? Welcome back. You're watching Markets Next Week. Hiral's here with us as usual with the chart attack. Hiral, a lot of big moves across the board, especially in the mid-cap anvil. What have you picked for us?
A truncated week for the markets, and the favorite has remained pharma counters. Let's pick up 3 to 4 pharma counters which have seen a breakout. To start off with Lupin, it has been the top gainer on Nifty, up by almost 4.8%. And if you see the performance over the YTD basis, from YTD lows, the stock is up by almost 44 to 45%. And we know that Lupin has raised prices of one of the diabetes drug by almost 200%, which is their top selling drug in the US. And additionally, it is the first to file for Glumedza, and the launch is likely in Feb, which has a market size of almost $1 billion. The other one that we've picked up in the mid-cap space now is Dishman Pharma. If you see the performance over the week, the stock is up by almost 18%. And from YTD lows, the performance is spectacular. The stock is up by almost 139%. And they did get a license to manufacture an API as well. The other one that we have is Marksans Pharma, up by almost 14% over the week. And from YTD lows, the stock is up by close to 98%. Same goes with Jubilant Life Sciences as well. The stock is up by almost 12%, but again, from YTD lows, if you see, stock up by a whooping 213%. So this is the kind of performance that we've picked up in terms of where the pharma counters go. And one more that has caught our eye is IDBI Bank. It has been the top gainer on CNX Mid Cap Index, up by almost 24% over the week. The chart clearly shows this performance. And if you see from YTD lows as well, the stock is up by a mere 10.5%. So a clear indication that majority of the performance on this stock has come in over this 1 week. So all in all, these are the stocks that we have picked up.
Mayuresh, let's talk about that. Some of the pharma stocks, some of the real estate stocks really flying off the chart over the last 1 week and 1 month. What has caught your eye?
So clearly as a pack, again, I think we'll be staying extremely cautious on the real estate pack. They're highly beta sensitive, and any interest rate cuts will have some amount of moment when it comes to the price action on these stocks. However, I think the core fundamentals have not changed for the sector as a whole. And I'm not branding all companies with the same brush here. Again, I think there are a few quality companies which are sitting on cash, land banks. But again, I think the core story remains weak. Pre-sales not happening at the pace one really expects, high levels of inventory. A lot of companies in the sector have got leverage problems, which means I think if the cash flows don't start coming through, they're still taking hits on interest and finance costs. So clearly I think a neutral stance on real estate as a sector, but specifically I think with pharma, which one is something that I liked at lower levels. I've been suggesting this stock right from that 130, 140 odd mark. We upgraded the stock post quarter earnings, and again I think it has exceeded our price. So I think a phenomenal move by Leishman at this point of time. But clearly I think we need to wait for results to come through before we take a call in terms of fresh upgrades. What I like from the mid-cap pharma space, probably Aurobindo Pharma at this point of time, strong ENDA pipeline, $70 billion odd drug going off patent, market leader in the ARV segment, the acquisitions of Natrol and Actavis helping it in the right direction, 80% of the business being driven by formulations, 18 to 20 injectables expected to come through over the next 2 years, limited capex that the company is doing, and valuations looking seemingly attractive. So Aurobindo is something that I'll prefer within the mid-cap pharma universe at this point of time.
Mayuresh, what's your thought on auto? I asked this question at a time where Tata Motors is languishing at a 52-week low. Some people continue to be extremely bullish on the stock. It's one of the worst performing, in fact, the worst performing stock on a YTD basis on the auto index. How would you be positioned in the auto sector? Where would the preferences lie?
So clearly, if I divide the auto stocks within the four-wheelers, the two-wheelers, I think within four-wheelers, Maruti is still something that we believe can show decent earnings upgrades. The product mix has been exceptionally good for Maruti in the quarter gone by. The discounting levels have come down. They sit on cash, and clearly I think the kind of capex plans they've got in the future, I think that should hold steam for them. So we're expecting a 36% earnings growth for Maruti over the next couple of years, and a cumulative rating on Maruti still persists. Tata Motors, I think, beleaguered with what happens with China, and we've already cut down our estimates in terms of both China volumes and realizations going down, specifically in the case of JLR for China. Ex-China, I think Tata Motors has been doing well. On the domestic front, the PV launches have held up pretty well for them. The MHCV segment has shown encouraging signs of recovery. So I think Tata Motors would be a bet that we'll be looking at. But again, I think one really needs to have patience of more than 2 years for Tata Motors. We continue to prefer Ashok Leyland at this point of time. I think the discounting levels at around 2,10,000 per vehicle, I think it's more or less peaked off in my opinion. And clearly, if you're looking at recovery, where we expect 18-20% volume growth to happen on the MHCV side, the market share at 30% overall, including the MHCV passenger and the truck business, I think has held up very well for Ashok Leyland. So I think the operating leverage benefits should start kicking in. The exceeded volumes from Pantnagar should aid them substantially going forward. Our own take is EBITDA margin should land between the 10.5-11% range for Ashok Leyland. And one more stock that we probably like from this space is Eicher Motors. So I think any probable declines on these counters, the two-wheeler has held up pretty well. The Volvo engine tie-up has done exceedingly well for them. And even the MHCV part, the CV part of the business is doing exceptionally well in terms of a surprise EBITDA performance in the quarter gone by. So something like an Eicher Motors, something that we'll continue to prefer, but again on declines.
All right, Mayuresh, thank you so much for joining us. It's going to be a hectic week ahead. Meanwhile, enjoy a good long weekend as well. We'll take a short break. On the other side, all the derivative market action you need to watch out for. September closed out on a somber note. Will October be stronger week? What are the cues indicating? More on that after a short break. Welcome back. You're watching Markets Next Week. September series has shut out. What will October really look like? What are the derivative cues? I've got Pranoy standing by with all the F&O action.
Well, what a series it has been for the markets. If you talk about the Nifty itself, we saw a gyration of 500 points between the high and the low for the September series. For the Bank Nifty, we swung between the high and the low to a quantum of 2,000 points. And having said all of this, the level was almost flattish. We pretty much did nothing for the entire series. Ending the Nifty ended down 1%, and the Bank Nifty ending marginally lower, around 0.1%. If you talk about levels, the Nifty ended at that 78.68 level, and the Bank Nifty ended a tad below that 17,200 mark. If you talk about the week itself, you saw the markets ending with cuts of around 1.5%, and obviously it was a volatile week. It was rife with volatility, the expiry week. If the broader markets as well moved pretty much in line with benchmarks, but have to say relatively outperformed as far compared to the benchmarks. The CNX mid cap ended mostly flat, and the CNX 500 ending with cuts of around about 1% for the week. The volatility index, in consonance for the kind of swings that we saw in the week, ended with a spike of around 14.2%, ending at a level of 20.88 compared to 18.29 where we ended last Friday. The October cumulative open interest stands at the last day of the September series, stands at around 1.6 odd crore shares. If you talk about the open interest data and the action for the week, for the most part, 7,700 to 7,900 put saw heightened open interest activity on the lower side, as also 7,900 to 8,200 call on the higher side. For the Bank Nifty, we saw levels of 16,500 and 17,000 becoming active, given the kind of fall that we saw in the initial half of the week. And you also saw 17,000 and 17,500 call seeing increased activity during the latter half based on the kind of revival that we saw. Interesting to note that going ahead into the next week, there's the first trading day of the October series. That's the window between the expiry as well as the RBI policy. That move, it'll be interesting to watch out for the Bank Nifty during that day and the week going ahead, because an anticipation of a 25 basis point rate cut is already being built in as far as these bank stocks are concerned, as also the overall index level itself. If you talk about the options levels for the October series, 8,200 as well as 8,300 call are seeing the maximum amount of open interest concentration heading out at the start of the October series, and 7,300 and 7,400 put on the lower side, as low as that, and a level of 7,800 put are seeing heightened open interest concentration. Another thing that deserves a mention for the September series is the level. The Nifty has ended the September series at a level which has been worst since the July of the 2014 series, and as far as the Bank Nifty is concerned, the expiry has been the worst level since the October of the 2014 series.
Pranoy, during the sectors and the stocks, where's really the rollover action been, or the open interest pickup really been? What should we be watching out for?
Well, talking stock specific, we saw some bit of a long build up as far as Lupin is concerned, up 4.8% for the week. There was Kane India that showed gains of northwards of 4.5%. Maruti was up a smart 3.8%. Infosys posting gains of 3.3%, as also a counter like Gas Authority seeing gains of northwards of 2.5%. Conversely, on the short side, we saw some bit of short build up as far as Tata Motors. That stock has been losing sheen off late, down 8.1% for the week. Mining counter NMDC also seeing cuts of an equivalent quantum of around 8%. Coal India down 7.3%. There was Bosch that showed cuts of around 7.2%, as also Bharti Airtel down northwards of 6.5% for the week. There are also certain counters to focus on that will be added in the F&O series starting the October series. So we have counters like BEML, Cadila Healthcare, Bharti Infratel, Marico, NCC, as well as TV18 broadcast that will start in the F&O series post starting the October series. So we'll have our eyes out on these counters as well starting Monday.
Thanks for that, Pranoy. That was all the derivative action that you need to keep an eye out on as we kick into October series. With that, it's a wrap on markets next week. A lot to track, a hectic policy. Thank God it's at least a long weekend. Thank you so much for watching.